welcome to this Wealth Professional Roundtable discussion. My name is David Kitai, Senior Editor at Wealth Professional. Today, we're digging into a question that sits on some of the core tensions in this industry. What does the future hold for independent advice and independent Canadian advisors? To answer this not insignificant question, we are lucky to be joined by Robert Francis, Chief Executive Officer at Peak Financial Group, Michael Konopaski, Managing Director at Designed Wealth Management, and Ainsley Mackie, Portfolio Manager with Verecan Capital Management. Welcome all.
Thank you.
Thank you.
For having us.
Look, I think we need to start with the definition of terms because maybe this industry struggles a little bit with defining terms from time to time. And since independent advice is not a regulated term in this industry, I will ask each of you, what is your definition of independent advice? Maybe we can start with Ainsley.
So independent advice for us means that the advice stands on its own with no financial tug on the sleeve. So no quotas, no product shelf politics, no compensation structures that quietly tilt the table. If investors can't tell whether the recommendation benefits them or the firm, it isn't independent. True independence is simply advice where the client's interests don't need to fight for the top spot.
Okay. Clear, succinct, to the point. Rob, would you care to offer your definition?
Sure, thanks. I agree with Ainsley on that. Independent advice is where the advisor is always free to recommend whatever is best. And this is without pressure and without preference, without commercial influence behind the scenes, whether direct or indirect, whether obvious or subtle. So it's a structural issue, not just a label. It's where the dealer and the infrastructure that supports the advisor is one where it's governed in a manner where every dollar is earned in a way that protects the advisor-client relationship. And there's no ambiguity about any revenues coming from other sources, directly or indirectly or through a parent. So true independence is really when the advisor feels confident that every decision they make is based on the best interest of their client and is made in conjunction with their dealer, working in harmony with that, with no other interest behind that.
Mm-hmm. This definition is sounding more and more like one that is easy to say, hard to execute from my understanding of the industry. Michael, I'll ask for you to give the last word on this.
So when we think of independence, we break dealers and ICPM firms into three categories. We see the three categories as bank. Second category would be non-bank, but not what we would call independent. And then totally independent would be the third category. If you think of the largest dealers in Canada, they're really controlled by insurance companies, fund companies, private equity firms, large US conglomerates, sovereign funds. And in our mind, if you have to go upstairs or overseas to get approval for something, we don't think you're independent. So the key to us is focused on voting control. We don't manufacture our own product. So, that means there isn't a conflict, nor is there a potential for conflict. So we think that's important. But it's at the advisor level, being able to design your business model, being able to design your website, being able to have products on the shelf that might not be available at another dealer. And it's about empowerment and helping advisors do what they love with really minimum interference, but maximum support.
Mm-hmm. Mm-hmm. Again, a clear definition, and that makes a lot of sense. And it's interesting to hear, the agreement between the three of you in this, and where there are some points of difference, where I'm sure we're going to dig into it today. There's a lot of that common thread of client centricity and alignment of interest seems to be the primary undercurrent in each of your definitions. Would we say that's fair?
Mm-hmm.
Okay. So from this now nice platform of agreement, let's move into the state of independent advice today. And I'll ask Ainsley, as the advisor in the room, what are the kind of core challenges you are facing day to day as an independent advisor?
Yeah, so giving independent advice, I don't think that's the hardest part. It's explaining to the clients that independence is actually an exception in this industry. It's not the norm. There's a lot of people out there saying that they are independent, but it's very difficult for investors to determine if those people actually are independent. So the industry itself, we're in a marketplace that rewards product placements and sort of prediction theater about processes and discipline. So staying independent to us means we're going to say no to shortcuts. And just because a decision, it doesn't scale very neatly, but it's going to serve the client better, we want to go that route. And falling back on the first part of trying to figure out if someone truly is independent, for us, we're constantly having to educate people as to what conflicts look like and when they really do matter.
Mm-hmm. Mm-hmm. Okay. So, Michael, can you take us to the dealer level and kind of lay out some of the challenges you see independent dealers facing in the market today?
There's so many, really. I mean, we only have a limited amount of time here, but I think that first, that for a lot of independent dealers, their stated vision from years ago when they started is no longer relevant. For us, as an example, we needed to reconsider things like capital markets. That wasn't in our original business plan, and we're starting to contemplate how that might fit into our business plan, but also thinking like a global company, not just a Canadian company. So we've recently been registered in the US as an RIA. So rather than thinking of, within the context of Canada, it's also thinking about cross-border, where most advisors have ties. And for us, it's thinking about the vision differently from even 3 or 4 years ago. For smaller dealers, there's a succession planning crisis. When dealers start, typically it's because the advisors, they know the founder or founding partners, and that builds up over time. So the first wave of advisors, maybe even the second and third wave of advisors, have ties to the owner or the owners. But as time goes on, when there's a sale to a large financial giant, the advisors and the clients just become a number. So there's a cultural crisis we see that's been going on, and it's accelerating. Also, if there's existing external shareholders, there's always going to be that balance, especially for public companies, where you're trying to increase or maximize the service to the advisor, but you're also trying to maximize profit for the shareholders. So, that math doesn't really work for all of the stakeholders. So how do you keep fees low for clients, the experience for advisors high, but also keep the shareholders happy? So we see that as a challenge. And then we can't ignore, which is the elephant in the room, the Canadian bank oligopoly is gaining momentum. So the brand strength, the loyalty, the control of both custody and transactional banking make it really tough for the independent dealer to grow. And it's unfortunate, but we saw in 2025 that the banks were winning and the independent dealer, generally struggled. Now there are some great success stories. I know that both Verecan and Peak have grown because I'm very aware of our competition, and there are some rare examples of success stories on the independent side of the industry. But generally in 2025, the banks were winning.
Mm-hmm. Mm-hmm. Okay. So Rob, to take this to you, we've just heard two situations of, I think, being pulled in many directions, being the servants of many, many different masters, and trying to find, avenues for growth that maybe, it's a tough tightrope to walk. I've clearly mixed 4 or 5 metaphors in this statement, but I'll ask you from your perspective as a dealer leader, how can dealers manage these challenges that both advisors are facing and that they are themselves facing in this wider marketplace?
That's a very good question. It's what many dealers struggle with and ask themselves with, and frankly, any dealer is not asking that question regularly is not looking at it closely. Those are deep philosophical questions they have to keep asking. I think the key is to not see it as two opposed questions, but really, how can we do both things at the same time? And what are the synergies between those areas? So how can we protect independence at the advisor level while at the same time building a scalable and worthwhile business for the long term? I think the advisor needs clarity, freedom, full independence for everything they do. The enterprise needs strong infrastructure, operational discipline, And when these things are working together and we find ways that one helps the other, then I think the business can grow and grow extremely well. So what we've been able to experience is that by avoiding any of the distractions that come with incremental revenue from product manufacturing or figuring out other business lines that are not core to serving advisors as a way to diversify and get out of the main activity of serving advisors. We found that by not having that distraction, not going that way, it does require strong discipline, but it gives us the opportunity to focus on what we are at the core as a dealer and how we can focus on the advisor. So by doing that, all our work is about streamlining workflows, removing administrative friction, giving advisors tools that helps them earn more in less time so that the organization itself benefits financially from that and becomes sustainable in the long term without those, what I call the dark side distractions.
Mm-hmm, mm-hmm. So is there a degree to which, and maybe I'll ask Ainsley and Michael to add to this as well, Rob, sort of staying out of advisors' way underpins a lot of the approach, and does that often lead to success in facilitating independent advice?
Yeah, the dealers walks a fine line between staying out of their way and being right in their way with all the best tools to propel them. So it's a delicate way of doing it, and for that reason, I don't see how that can be achieved if we become slave to many masters. We are quite passionate about not having any product, not having those distractions. And that's where this whole independent movement comes in. And Canada is one of those areas, and Michael touched on it, with competitive pressures that make it such that we sometimes wonder, is there a place for independence? But it's really one of the only markets in the world where there's such a lopsided fight, and it is changing. The last 20 years, every year we see progressively the market share of independents as a whole doing well, with some struggling and some doing extremely well, of course. But in other parts of the world, this is not even the topic of discussion. It's understood. There's the independent sector and the non-independent. Whereas here, we're constantly talking about it. I believe regulators are paying attention. I believe consumers are paying attention. And it's becoming more and more prevalent that the question of true independence is out there in client conversations, in dealer conversations. We're feeling it quite a bit with advisors who approach us. And I believe regulators are starting to pay attention to it.
Mm-hmm. No, fascinating. I'll ask Ainsley or Michael if you've got anything to add on these points.
I think Rob did cover really well. Like, honestly, the dealer, their job is to remove any friction that's going to prevent us from talking to clients. So if they've got their systems in place, their compliance all sorted out, it makes us doing our regular jobs that much easier.
Mm-hmm. No, amazing. So to move this forward, and I think already in the conversation this has been raised, but I wonder if each of you sees one or two existential threats to the independent model today. And Michael, since you raised the point about, the banks winning in 2025, I'll ask you to start. Do you see that as an existential threat, or do you see other existential threats to the independent model?
So with my first point, I think I may deviate from the norm or the mainstream. We don't see regulation as a threat. It's a way for us to help the advisor develop their practice. And, to me, it's tough to hear how, increasing regulation is becoming an impediment for independent dealers to grow, because we like to think of the regulators as our partners. We have good relationship with the regulators. And for us, that's not really something that we consider to be a threat. But I would say that the three main threats to the independent dealer, I would say both in the short run or in the long run, is the fact that, and it's a structural difference between the US and Canada, but it's the stranglehold that the banks have on both custody of investments and transactional banking. So when you consider the advantage you have over a client, especially if you have private banking for a high net worth client, to control both of those, custody and transactional banking, I mean, it's really difficult to compete against the large banks. Then there's scale advantages or disadvantages for the smaller dealers or independent dealers, in that, I'm sure, Robert would love to be able to pay $20 million for an advisor to join us from a bank, but, we just don't have that type of capitalization, and the amount of money sloshing around that's buying up books of business for us in our marketplace, we just can't compete, nor do we want to compete in sort of outbidding for these client lists and for these advisor branches to join us. And in some cases, you're seeing $15-20 million paid to the larger branches to come over. And we think that needs to be legislated. We think there needs to be rules around that, similar to some of the regulation in the US. And lastly, I think fintech is a threat in that, right now we're keeping just as close of an eye on Wealthsimple and what they're doing as we are with RBC and what they're doing. So we have seen Wealthsimple, let's say, more or less struggle for 6 or 7 years, and all of a sudden they've gone from 50 billion to 100 billion in assets under admin within 12 months. So you can't ignore them anymore. So I would say fintech would be the last one for me.
Okay, thank you. Rob, your views. Do you see any particular existential threats to the independent model?
Yes, as Michael was speaking, he triggered 3 threats that I see. The number one is I like to call fake independence. There was a time where being independent was something we had to tell advisors what it was, what it meant, and then advisors would tell their clients. We understood. Today, almost every single company out there suggests that they are independent. Independent of what? I'm not too sure, but they say independent. We see it everywhere, including product manufacturers. So I think there's an existential threat where everyone wants to be like you. That means you're onto something good. But I would caution everyone to differentiate between true independence and fake independence. And that's going to be a threat to the true independence if they don't take that threat seriously. The second one is, Michael touched on it, it's unfair competition. We have models and what he's referring to, the incentives and the checks being offered, which are modeled based on the revenues that would be made through the incremental product revenues. I believe regulators need to look at that. There are jurisdictions in the world where those are either banned or controlled, or at the very least disclosed. What happens now is we are facing unfair competition where we are competing in an industry, the independent advice space, where entrants into that have product and are using it as a gateway to products. So it's a loss leader for them to operate the dealer. And that creates not only unfair competition, but serious questions with regards to legislation that deals with competition. So I think that's a threat that has to be addressed by the independent dealers. The third one is transparency, is just disclosure. Right now, disclosure of your independence and any ties of your company to product are not absent, but they are not evident either. And I believe there is also an existential threat if independent dealers don't take a stand and make sure that regulators are aware of what goes on the street, so to speak, and make that transparency disclosure part of the information clients get when advisors move over or are leaving the independent side or are moving to the independent side and why they're doing it.
Okay. Again, fascinating and opening up a host of additional questions that I think we might want to dig into in a moment. But Ainsley, to take us around the room, what do you see as the sort of existential threats for your work?
Yeah, so Rob really nailed it regarding the dissolution of the terminology of independent, because we're finding that the market, any firm, they can market themselves as independent. There's plenty of that out there. I see a really good comparison to the ethical investment space. Every mutual fund company, ETF company, they start throwing around ESG, ethical, sustainable, but they're taking advantage of a trend. They're not necessarily products that are ethical. So there's plenty of people that are saying that they're independent, but they're not. And it's difficult for investors to actually figure out that they're not independent. The other points that the other fellows have already touched on, which I also agree on, was threat of consolidation. So it's quietly pushing advisors to a more uniform product set because they don't have the capacity to deal with additional regulatory requirements. So they get absorbed into these bigger shops just because they don't have the manpower to be able to keep up with all the changes. So none of these necessarily kill independence outright, but it erodes the ability for firms to fight to preserve that clarity and the client first incentives that they originally set out to do.
Okay. Yeah. Again, fascinating. And I want to start digging into these. And I think maybe one way to think about it is, one of the ways to succeed despite threats is just to grow. And so I'm curious as to what has worked around growth. And maybe, Michael, you could start by sharing a little bit of what you've seen of where independent dealers and firms and practices have been able to succeed. How do you think independents have been able to grow in the past year?
Well, I think we have to separate the group of independents into two categories. One would be inorganic growth and the other would be organic growth. And in terms of organic growth, which is the majority of the growth in the industry, that is happening through mergers and acquisitions. So there's never been more activity in my 30 years in the industry of the buying of client lists, of the buying of smaller dealers, of the buying of ICPM firms. And, this is a faster way to achieve growth. I mean, you have issues like consolidating two different cultures. But generally, if you're trying to grow and speed is your main goal, I've never personally seen more of that in 2025. In terms of organic growth, we use blue ocean strategy, and we have since we started, which is essentially a strategy where we actually don't compete. So when we think of who our competition really is, we don't feel like we have any because we feel like nobody's doing what we're doing. Now, when I say that, I'm sure that, both Verecan and Peak are trying to grow their client list and their assets under administration and assets under management. But in all reality, if you look at the three different business models of the people on this call, they are different in that what we've tried to focus on is not like our history and our prestige. Like, we can't flex our muscles and compete against the banks, with the 100 years of history. So what we've done is we've kind of gone in a very different direction, and you'll see our marketing is more, I would say, identity driven, more personal, less corporate, but trying to maintain professional. Something that really nobody is doing, maybe one or two others. We use a lot of direct mail. So we sent probably 30,000 pieces of mail to advisors last year, introducing, what we do to the advisor. That's generated a lot of business for us. It's a dirty way to market. I mean, you have this big printer. You got to mobilize staff to stuff envelopes, stamp. Some of this can be automated to some degree, but generally, in our minds, something like 1/3 to 40% of independent advisors, they either don't have a website nor do they have a LinkedIn page, or both. So then how do you reach them? Like, if your strategy is 100% digital marketing, you're missing close to 40% of the potential marketplace that you could be attracting. So we've had a great deal of success through direct mail. We don't see too many of our competitors doing it. And LinkedIn has worked for us. So, we're very active on LinkedIn. I'm probably spending 2 hours a day on LinkedIn, just trying to create original content that we believe is authentic and transparent. And, that's paid off for us. It's a bit of a gamble because, like, there's times when I post a picture of myself sleeping at an airport, that somebody else has taken of me, and it's trying to let the outside know that we're humble people, we're real, down to earth people. There is a downside to that, and I'll talk about it a bit later. And that's you're trying to compete in the corporate world against the banks with the higher net worth marketplace. On the other side, you're trying to resonate with average people in small towns in Atlantic and Western Canada and Quebec. So, the challenge is how to look different, but also feel like you're a professional and corporate dealer. And then lastly, we've done some really, I would say, I don't like the term outside of the box, but generally things that you wouldn't find that would be too common. So we've created some, I would say, informal partnerships with our competition. Let's say an advisor is unhappy, they've decided they're leaving their dealer, and they call one of our, let's say, a dealer that may seem as they're a competitor of ours, but the advisor maybe just doesn't fit the business model of the dealer that they've called, and they're like, well, now where do I go? Like, I thought I might be interested in joining your company, but as I'm starting to find out, I may not fit in your model. So how do we get our competitors to send us business where it might be more suited to our model? So what I believe is advisors join dealers for the wrong reasons. They join for money. They join for prestige. But if you think about Maslow's hierarchy, a dealer should really go where they fit in and where they can be themselves. And I think, generally, where we've done well is in some areas that have been underserviced. For instance, we only started 4 years ago, but we have close to $2 billion in Saskatchewan. And, when we sat around, in our planning stages in 2021 for where we would, see our future growth, like, we certainly didn't think it would be in Regina and Saskatoon. It's not something that we really spent a lot of time considering. But then, instead of targeting a market, what we found is for organic growth, the market has to emerge sort of on its own. And then over time, the more we get out there, the more we travel, the more we talk to different people in different parts of Canada, we're finding marketplaces that we never imagined. So I think it's just being open to, shifting your maybe intent, shifting your vision, and just focusing on solving the advisor's problems. Really, that's how you grow. Is you get a call from somebody that's unhappy, and you find out what their pain point is, and if you can solve it, then you tell them, and if you can't solve it, then you build that solution. Right? That's really how we've done it.
Mm-hmm. You're raising an interesting question that I think I want to put to the whole panel here, and it's around the use or lack of use of zero-sum thinking when we think about this industry. Because, the advisory firms and advisors, they're in the AUM game. There is the idea of there is X amount of AUM and you want to increase your share of it. It's inherently a zero-sum way of thinking about things. But the way you've raised stuff is some of this organic growth, some of this emergence maybe stems from not necessarily an idea of infinite growth, but the idea that growth can come from unexpected places if you're laying the right groundwork. So I'll ask Ainsley and Rob, first of all, do you accept the premise of my question, or am I Looney Tunes here? And second, do you think there is value in kind of approaching things zero sum, or if not, how do you walk yourself back from that?
Well, we definitely see there's lots of opportunity for organic growth for us. For the areas that we are in, there's a lot of cross-border action. And for years, we've been talking about how do we tap into the US side of things, because it's going to serve our clients better. And there's a huge extra market side that we can potentially tap into. So we did launch our Verecan US side this summer. And the referrals that we're getting from accountants and lawyers who needed someone who was going to be dealing with cross-border has been amazing so far. And we just see this unlimited potential for that side of things. So as Michael said, staying open to making changes, and as you see needs arise, finding a way to help those clients.
Mm-hmm. And Rob, your view on kind of a way to either apply zero-sum thinking or to get rid of it, whether it's actually beneficial or maybe can be restrictive.
Yeah, well, I think Ainsley touched on it. The opportunity is much greater than we can even imagine. There's only 40%. I'm told there's 60% of the population lives from paycheck to paycheck. They don't have much in terms of savings. I'm told less than 10% of the population has 100,000 or more accumulated for retirement. Those are incredibly ridiculous numbers to us in the industry, because we work every day with people that are planning their retirement and are set up for that. So I think if we can put a dent in that, and a peak, our mission is to improve people's quality of life through the way they use money, right? Which is similar to I guess what most financial advisors are seeking as their outcome. If we can every year grab at that and help people have a better future through the way they use their money, I think the market gets bigger and bigger and it's not zero sum. So I see a future where with everything converging, be it AI, the competitors, the different entrants using fintech, every day there are more and more people that are becoming aware of the importance of taking their finances personally. And taking it seriously and personally getting involved in it. And when they do, it slowly leads them to the need for an advisor. I don't think you can do this yourself. And frankly, like the medical industry, I don't think anybody should dare buy any medication without a prescription. Well, you should never venture into any financial markets without a good advisor.
That is an excellent point to land on. I'll say I come from a family of doctors, so you're resonating with me, and I hope with our whole audience. But Robert, to stay with you on this, because you've started to raise some of these points about kind of future challenges. And we've already seen a lot of future challenges and threats articulated by each of our panelists here. Speaking for dealers, how can dealers adapt what is working and what is spurring growth and what is resonating with clients and, potential advisors from other firms? How can advisors adapt what is working to meet these challenges in the future?
Well, first, I think dealers need to embrace the changes that are coming with regulation. There are significant changes coming. We've heard all about those in the various briefings from CIRO and from the CSA. I believe we reached a point where we've done, as an industry and the regulators combined with the industry, done a very good job getting a lot of transparency out there, notwithstanding what I said earlier, that there's still room for a bit more. It's time now to look at the efficiency of our compliance. And as that happens, regulation will probably become more efficient, easier. The regulatory burden placed on advisors, firms, as well as clients will reduce. As that happens, I think firms will have an opportunity and an obligation to adapt by using that time and shifting the advisor's way of working from what is today an extremely heavy administrative and compliance-based practice to one where they can continue to build quality relationships with their clients and bring great concepts, great ideas to them. I'm not sure that there will be significant innovation in financial planning strategy. The principles we have today are the same principles we had 20, 30 years ago, or even 100 years ago. Try to save a little bit more than you spend. Try to earn more than you need to save and spend. So those principles will stay. And in the investment side, the same thing. But I think technology, AI, will fill in the gap for regulation and compliance, but will also create more time. And the dealers who take advantage of that and invest in the systems, invest in those tools that will help their advisors and their clients will start to see those deeper client relationships. And as a result, the advisors will do better, and that's how they'll adapt.
Okay, thank you for that. Ainsley, to take this again to the advisor level, and this speaks to that point earlier of whether advisor or dealers are sort of getting out of the way or are standing in the way with the right tool. What do you want to see from your dealer to both kind of meet your operational needs and all of the, scale and issues that come with that, and to ensure your independence?
Really, we need a clean runway. We need systems that work, reporting that's accurate and compliant that's practical. We don't want to be bogged down with all the bureaucracy. So operational excellence is how we can actually practice independence. If the dealer's platforms help me focus on clients, it's a win-win situation. The other thing really that I do want to point out is that transparency matters from the dealer side. I want to know exactly how much they're getting paid, if there are conflicts, and how they're being mitigated.
That makes a lot of sense. Let's keep going into the future, because this is the fun speculative part that I think is going to be increasingly interesting for our listeners here. But I want to know what each of you thinks the work of an independent advisor will look like in 5 years' time. Given the pace of change, it might be completely different. But just give me a snapshot of how you view the future. And maybe again, we'll start with Rob on this.
Okay, so I think of the next in 5 years time. I don't know. Let me give you 10 or 15 years, and then maybe it'll happen in 5. Because I'm horrible at predicting what goes on. I'm horrible at predicting when it'll happen. I think we can agree on what will happen. It's just the when that we can't figure out. But let's say in 5 years or maybe 10. Advisor wakes up, enjoys a cup of coffee prepared by one of his many robots who operate in his house. and then gets a briefing, an electronic briefing through an AI agent that says, here are all the top things that occurred in the lives of your clients last night or during the day. And here's a list of the ones you should be calling between now and 11. I've set up 15-minute phone appointments with each one for you. Would you like me to proceed? And dial the first one. So the advisor becomes strictly involved in relationship and speaking to clients and doing stuff. Well, this is already there now with note-taking technology. Robot, an AI agent takes all the notes of those calls, puts them in, does all the follow-ups, puts them in the file, and ensures the advisor is now free by lunch to go enjoy a lunch with their favorite wholesaler who will tell them all the virtues of these new products that are out there. Because in the perfect world, the advisor of the future has nothing to do with product manufacturing and is only involved with a true independent dealer, be it any of the three on this call or any of the other true independent ones. So I would see advisors spending much more surgically targeted time in doing those things that had the maximum impact for their client's success, and almost zero time on anything that is considered a support function to that, including proper regulation, proper documentation, proper business management and business planning at their end. So that's what I see as an advisor of the future.
Okay, that's a very optimistic view. There's shades of the Jetsons in that, and I like how this sounds. Michael, what's your kind of view of the next 5 to 10 years? What will the future hold?
Well, I'm focusing on the prompt, which would be like, what will it look like, rather than what so I'm trying to separate could from would from should. And I think what it will look like, and I would say there's two very different types of advisor in the year 2030. So, most really good advisors, ones that are keep in touch with their clients, they've treated their clients well over time, they will get referrals. The market will more or less grow over time. So most advisors, like I would say, if an advisor didn't even have a computer, a good advisor would double or triple their practice over the next 5 or 6 years. Okay, so that is one sort of, and I do believe that we, at our head office and many of our advisors are using agentic AI, but you can still run this business off of pen and paper. We can't kid ourselves. Like there's some very good advisors that don't have any technology in their office. So I would say that's one part of the conversation. However, it depends on how motivated the advisor is to grow their practice. So if they're motivated to grow their practice, this is a whole different look in 2030, because you can now scale 10 times bigger in 5 years versus when I started in the business, I just couldn't make more phone calls. Like back in 1995, it was a numbers game. You could only make so many calls, right? To get so many leads, to get so many closings, to get so many clients. So to us, using things like Google Analytics, using things like AI apps to do marketing with search engines, I think the sky is the limit. Like an advisor can scale, and we're seeing this. I've been going to the big US conferences for a long time. There's people that just get into the business and a couple of years later, they have $200 million under management in the US because they see the future. They know what is needed to scale fast. And I think it comes down to, do you want to be a financial planner? Do you want to be a money manager? Some combination of both. But aside from technology, which I think is always going to be the marquee part of the conversation, I think you're going to see the market in Canada, to me, is going more up market. Like the smaller client, the smaller advisor, doesn't have a lot of options in 2025, but we'll probably have even fewer options in 2030, which is unfortunate. But to us, that's a trend that we're seeing. I see a ton more cross-border, where there's Canadian people moving to the US or vice versa, or the skill set needed to file a US tax return for a Canadian resident, or for a Canadian advisor to deal with a client that lives in Texas that has plans custodied in the US. We see that as as an area where there really isn't a lot of competition, but a high amount of demand. And to us, that's a good recipe for the future, especially in we're now in a more global environment. And then I think it's having advisory teams provide a wider range of services. So, what we've been seeing in the US is where the advisor is sort of separating the planning from the money management, which is a growing trend in the US, but we don't see that in Canada. What we see is more like a family office setup where you have, yes, you may be outsourcing the money management, but you're also maybe having a lawyer on staff, not just making referrals to lawyers, or maybe having a CPA or two on your staff, not just making the referral, having that more integration rather than just saying, we don't do this, we'll refer it to somebody else. So I think it depends on the context, but generally in 5 years, there's two types of advisors, ones that are going to continue to do the same thing and be successful, and ones that really see the big picture and it's more than a hobby for them. And they're going to use all the tools available to scale fast and provide great advice for their clients.
Okay. That's a really, really interesting picture of the future, and maybe less utopian, but also comes with a view of the work that needs to be done still. Ainsley, bring us home on this. Where do you see the future?
Really, for independent advisors on a day-to-day basis, I think it's going to be way less about making actual investment selections. It's going to be about trying to interpret a world that is filled with a constant stream of noise. So clients are constantly being bombarded with information that we're going to have to be able to help them translate and calm down a little bit. Independence is going to matter more because clients are going to gravitate to people who aren't trying to sell them something. I really do feel like the human element is going to be the differentiator for anyone succeeding in 5 years.
Okay, fantastic. Robert, you painted a very, very interesting view of the future. And again, we've been adding to it with Michael and Ainsley's views. What do you see as Peak's place in that future?
Well, I see Pete participating in this next generation of independent advice that everyone has been just talking about on the call. I don't think we're there only to protect their independence. I do think that gives us our reason for being, but we also see a future where we're amplifying their impact, as I said earlier, what they're doing in their community and the impact on the whole Canadian public when it comes to investment and savings and financial success. As the industry becomes more complex, advisors are going to need more capacity. Peak needs to play a role in building an environment that gives them the ability to do that, get the time they need for other things, diversify their own way of working. But an environment where technology and AI are going to remove the noise and elevate that human relationship to be the center of everything that they do. I see Peak being the partner that independent advisors could choose as one where they're building a foundation where they just have the one belief, which is true independent advice can change lives, and we have the right partner to support us in doing that.
Okay. Michael, again, you laid out a lot of the work that lies ahead for independent advisors. What are some of the specific features that you see independent dealers offering or having in their shop or on their shelves in the future that they don't have now?
It's quite fascinating that even in the last 2 years, like we use AI heavily and machine learning at our head office. So just as an example, our next 6 months of budgeting is going to be hopefully done entirely by the machine. Obviously, we're going to go in and test and audit and take a look at the situations in the different departments, but we think that it's possible now to do those kinds of things. So I think that the answers that are most popular or most frequent in the industry would be advanced AI personalization, integrated technology, so like a single sign-on turnkey asset management platform, those kinds of things. And I think another sort of popular comment would be scalable access to alternative assets in private markets. But, those seem to be the trendy sort of answers. I think for us, what I'm seeing on the ground floor, and I think this is extremely important, and it's not being talked about much. But the high net worth client has changed in Canada. So when I was in the business in the 90s, if you had $1 million, that was considered to be high net worth. But now we're seeing in not just the larger cities in Canada, but you go to, rural parts of Canada and you're seeing people with 15, 20, $25 million. And I think that as people become more wealthy, and I know even inflation adjusted, I think that the whole concept of high net worth has changed. And if you don't have access to private banking, you can't compete in that arena. It's impossible. The bank will not if there's lending involved, the bank won't let the custody of the investment go to some other independent dealer. They just won't. So if you can't solve for that, you can't be in that market. And it's something that we think about, we talk about all the time, and we're going to be solving for it in the future. The last two things, one of them deals with custody. And it's a tough thing. Like, you can't just start up and be a custodian, but you have to have either more control over your custody or offer multiple custodies where the client, the advisor, has a choice of the platform. And in the US, I mean, it's no big deal for a firm with $800 million under administration to have 3 or 4 different custodians, because custodian A may be able to do something that custodian B can't, and custodian C might offer some value added somewhere else. And I think in Canada, the independent dealer has focused on volume and scale and stuffing all of the business through one channel to get, pricing or to get some other sort of advantage. But I think going forward, it's thinking about the custody of the investments differently from the way we have in the past. And then the last one, and this is, to us, this is a 10-year problem we have to solve as a business. I'm not suggesting that I don't want a hot take. I don't want to introduce a polarizing topic here, but all you'd have to do is look at Questrade and Wealthsimple, and if you don't control the transactional banking of your client, you always have that is an existential threat that will exist forever. And 80 to 90% of investors and clients in Canada think the bank is great, right? So we can't go on the way we may have in our early parts of our career saying the bank isn't great and there's no service and there's they're not sophisticated and all stuff. The bank is very sophisticated. The service is very high, and they control my biggest client's transactional banking. So how do you solve for that? And I mean, that's not a 5-year thing for us, but I'm thinking that in 10 years, we have to solve for that as a dealer. And I don't want to speak for my colleagues here on this call, but that is something that we've started to think about very seriously.
Okay. So there's been a lot of change forecast through this conversation. Again, in whatever view of the future, a lot of things look like they're going to be different. They're probably pretty different at the end of this year than they were at the start of last year. But Ainsley, I'm just going to ask from an advisor's perspective, how can you keep pace with all this change, adapt to all this change, add on these tools and features that are long-term accretive to efficiency, but short-term are a bit of a pain to learn? How can you do all that while still ensuring that you are serving your clients to the utmost highest standard?
Yeah, I think it really comes down to focusing on the constants rather than the latest trends. Like, yes, AI is popular right now, but we need to focus on what parts of AI would really be helpful for an advisory firm. The markets are going to keep changing. Technology is always going to evolve, but clients are still always going to need a few things: clarity, honesty, and discipline from us as an advisor to make sure that we're not making irrational decisions about what the markets are doing. So keeping pace with change doesn't necessarily mean adapting every innovation, but we're going to adopt the ones that give better advice to our clients and gives them a better long-term outcome.
Okay. So to sort of sum up this whole conversation, and I won't try to sum it up because I think we're talking about something that, Rob, you highlighted. These are pretty deep existential philosophical topics for the whole industry. And in our hour or so of discussion, I don't know that we're going to be able to come to the complete resolution, but I think we've given a lot of people areas to think about. And to sort of put a point on that, I'd like each of you to offer up a question, a question that you want advisors who are watching this, advisors who are considering the future of independence to ask themselves. And maybe Ainsley, I'll stay with you to offer it first, but what do you think is the question you want another advisor to be asking themselves, having listened to this discussion?
If you stripped away every compensation incentive, product partnerships, and sales metrics, like, would your advice change? If it would have changed, then I don't think you're independent. It's more of a marketing strategy.
Okay. Michael, your question that you want advisors to ask themselves.
So for most Canadian investors, stability is more important than independence. And it's unfortunate. I hate saying that, but the data would reveal that's the truth. So at Designed, we need to position ourselves not just as independent, but also as structurally stable, which is, what we believe the most important criteria for an investor is. It's not. I don't think going forward it will matter as much that we're independent, but that we're good and that we're sound, because it's people's life savings. So I think that the narrative will change, and I think it maybe has to change. But I would say that there's nothing more important to an advisor's practice than their interface with their dealer. And I would say, because for most independent advisors, 90 to 100% of their clients are going to travel with them if they move from one dealer to another. So I think that if they're unhappy, they need to ask, give me concrete, what are the concrete answers you can give to me about the future of this dealership? And we put everything in writing. So when somebody asks us, when are you selling? I put it in writing. I give them a concrete answer that they have, that they can save for the future, that they can refer to, so that everyone knows we're all on the same page. So that would be mine.
Okay. Robert, last word to you. What is the question you want those who watch this discussion to walk away with and ask themselves?
Well, I think advisors need to answer a very direct question for themselves. It's, is my environment truly empowering my independence? And we believe that it is empowering your independence if your dealer, who, as Michael said, the interface with your dealer is probably the most important relationships for an advisor, more than any single fund supplier, product supplier, or whatnot. So that relationship has to be one where you, in your due diligence that you do, and in your sales pitch to your clients that says that you are totally independent, that question is one that you need to answer in the same way when you're talking about your main partner, because only then can you ensure that all your needs, all your goals, and all your interests are completely aligned, not only between you and your clients, but between you and your dealer. So no indirect compensation, no subtle, over coffee, could you take a look at this product? No presentations from the parent company that come in before others. I mean, it's black and white. It's not negotiable, just like advisor independence is fully non-negotiable. So asking ourselves as advisors, is my environment truly independent is probably the most question. Second is assuming the dealer is fully independent. And if we don't know for sure, well, the answer to this question might do it. Is the advisor doing everything they can for me to have a much better experience with what I'm doing with them and with my clients? And when there are no distractions, there's nothing else being done for them, but that gets a big bonus because there's more in-house products sold through their managers and whatnot, then we know that they're fully aligned. And I think in the future, those advisors who ask these questions should all be coming to a similar conclusion if independence is at the core of their offering. And I recognize, though, that is not at the core for everyone. So to answer one of your earlier questions, and in terms of how we see growth and whatnot, ultimately, there was a saying way back when where advisors always end up where they belong. So advisors will always choose the best fit, and dealers will also choose the advisors that actually fit with those values. Because if they're fully independent, they won't be attracted only to the revenues from that advisor, but really, is there a fit for the long term?
Mm-hmm. Advisors will always end up where they belong. I like that as a final takeaway. I appreciate hugely the discussion that we just had. Thank you all so much for bringing your varied expertise, your different viewpoints, and just engaging on this topic. I know we will have more conversations on this topic in future, but thank you so much for starting off our year with something just so interesting. Thank you for your time.
Thank you, David.
Thank you for having us.
Thank you.
And thank you to all of our viewers for Wealth Professional. I have been David Kitai. Have a great rest of your day.